Hello and welcome to another exciting episode of Finance Footnotes. I'm your host, Brent Stransky, joined by my friend and co-host, Zach Miner. Today is August 5th, and we're going to be talking about some notes on the third quarter. Zach, I've got some high-level stuff, going to keep it pretty quick and moving. It's the middle of summer, and I think probably less than a few thousand people are going to watch this episode. What do you think?
Over under 10 million.
All righty, moving along here. Only goes out to the most important of people, by the way. Um, Quick litmus test of where we stand. As usual, I have a clipping here from the Wall Street Journal this very morning. And strange enough, Zach, you can see I highlighted there. We are, in fact, looking at all-time highs, not only in the Dow, but also the S&P 500 as of yesterday. You can see I highlighted there in red that there was some consolidation going on for the last several months. From June and July, the market was trading within a 5% range and then really broke out of it over the last couple of days. But I also wanted to highlight, so as the market is up a little over 10% year to date, the broad market S&P 500 index, I wanted to highlight, Zach, that it's not every asset class. In fact, bonds, as of this morning, were down year to date. And over the last 5 years have also been flat. So, that big component of a, 60-40, 80-20, 50-50, 40-60 portfolio has really been a drag on assets for those more conservative clients. So just a little bit of where we are and want to spend some time. How do we get here? Zach, I think the primary reason, of course, is the earnings have just been like mind-blowing. And according to LPL data as of Monday, with about half of the S&P 500 constituents, or maybe 60% reporting, year-over-year growth is tracking a remarkable 46%
Amazing.
compared. It's incredible. I think if people asking why do stocks go up, there's a couple of reasons, but I think one of the primary ones is the company's earnings. Earnings have been exceptional, amongst the best ever. And when companies are earning more, typically they're worth more. So this is a real interesting chart here from our friends at Creative Planning. And if you look at the profit margins, so there's revenue and there's profit margins, about the highest ever. 16.7% across the broad market index. But it comes with a warning. I highlight there in red, it's very mean reverting. We should see this kind of climb back down to long-term averages as new market players enter to reap the benefits of the high profitability. So that's the way capitalism works. And we should see kind of this mean reversion over time. Just a little bit of a,
Maybe.
yeah, maybe. It is a big capital investment to get into some of the AI. Is that what you're thinking?
Yeah, well, and also just the fact that, if this AI infrastructure plays out the way that the boosters will, the optimists say it will, the idea is that it's just going to make every company much, much more efficient, which should potentially lead to being able to command a higher profit margin because you're able to achieve, even if your revenue's flat, right, you might be able to achieve that in a much more efficient way. And so that will boost margins potentially permanently. And I mean, I think you're even just seeing that, pre-AI, just with because you can take this chart here and expand it backwards another 20, 30 years, and it's just been steadily climbing, right? I mean, it's not just in this last little, couple quarters. And I just think that, internet, the ability to communicate much more quickly, to get products to market much more quickly, has just led to a kind of a re-rating higher in the ability of efficient companies with strong moats to have large profit margins. So I think it's just
I
a
think
potentially, and we talked about this a few times, when you go back and you compare things from today to the early 90s and 80s, like those comparisons may not make sense as much.
very much so. Three dangerous words in investing this time is different. Maybe it is different. We'll have to wait and see, but it certainly feels different. So moving along, where are we going? Listen, we're this bull market, according to the folks at Carson, 3.8 years old. The average since 1950 is 7 years. So we could kind of be in the middle innings here of this long-term average. And you can see that while the market does feel very frothy, up, you'll see on the next slide how much it's been up in this bull market. But you can see it actually is kind of on trend for the previous six major bull markets. So just to kind of give us a 30,000-foot view of where we are, it's kind of on trend, Zach.
There's nothing really particularly remarkable about it when it comes to length or breadth or magnitude of bull markets past. I mean, it's a pretty basic it's a pretty basic bull market, right? And I think you can get kind of lulled into the thinking that where's the next bad thing to happen, right? And, you kind of keep waiting for it. But the reality is that bull markets don't die of old age. They something happens to kill it, and we're very early on, I think, in terms of like tenor of previous bull markets.
Exactly. And so I just want to highlight that there for folks. It could be, it could be that the bear market starts tomorrow. It could be that, in fact, the market was up for several more years. So we'll have to wait and see what happens. The next chart here from Carson Wealth, just kind of showing you the last 8 bear markets and their returns and how long they lasted. So listen, we're kind of right in the middle of it. And it's very rare for a market not to last the average of 7 years thereabouts. So this current bull market up 115%. And all the while, if you ask the average person on the street, I think folks think the market's highly valued. But I think if you look towards the technology sector, information technology, the price to earnings multiple is 20, Zach, compared to about 26 over the last 5-year average. So what we've seen here, as the earnings have really increased, the valuations based on price to earnings have come down, meaning that they're more affordable. So I think most people would be kind of surprised by this, that, if looking back over the last 5 years, this is actually, in terms of a valuation metric, one of the better times to be invested because the earnings are just so dang good at the moment.
Yeah, I mean, tech sector's up 30 something percent. Communications, which is like you can kind of call that. I'm not sure if this, no, it is information technology, so this shouldn't include the communications. But yeah, up 30%, but their earnings are up much more than that. And so like the multiples actually come down year to date, even though you continue to see prices go up, but their earnings growth is outstripping that, right? And so the PE ratios are coming down, which is, I think, not something you're used to, right? Usually,
Yes.
there's a component of multiple expansion that happens in these types of markets, but so far, I mean, the earnings are so good that even with a significant rise in prices, the multiples coming down.
The earnings have been absolutely astounding. And what's been happening is there's been a broadening in participation in the S&P 500, whereas it was led by the Tech 7. Their year-to-date performance has actually underperformed the median average weighted index, which
Yeah.
is up meaningfully more. So you're seeing a lot of the stocks catch up there. So there's been this broadening out, which is typically something technicians, such as our friend Zach, like to see in a healthy market. Um, I
Yeah, I
want
mean,
to turn it.
real quick too. Just, I mean, if you can just look at like the Russell 1000 value versus growth. I mean, if you ask the average person who's not really looking at it, like, hey, what's driving the market forward? They
Growth.
probably tell you, the growth. It's like, but the Russell 1000 value is up 21 or so. The Russell 1000 growth is up 5, right? So
Yeah.
it's not what you would think is driving things forward. It's kind of the complete opposite, and that really speaks to a healthy broadening out of the market. It's the generals kind of marching forward, but everything else coming along with it, and that's a really healthy sign.
Yeah, it's a great sign as we move forward here. Zach, you said something which struck me. It was it's hard to know what moves the markets. I mean, the news yesterday, the market was up significantly, and then people kind of blaming it on the news coming out of the Iran controversy, but seldom what they say it is actually driving
Controversy.
force.
That's
And
we're calling it a controversy now.
the war, the bloodshed, the
it's
miserable
a
nature of
it's
the
a
Middle East.
controversy. That's a good one.
Well, I think the controversy I'm trying to get at is that there's this like repetitive news
I
cycle
know.
coming out of
I know.
Washington and Tehran about what's going on, and no one has any idea. That's controversial because we're stuck in the wilderness here. But
Right.
just the point that what you see on the headlines that drives markets, as often not what's driving markets. The markets are fickle and variable by nature. And talking about sentiment, I just want to highlight this chart. This is the exact same slide Zach actually had in our April get together, but I just want to highlight this is the CNN Fear Greed Index. I think it's so interesting. Early April, things were signaling extreme fear, and then the market really ripped from here, and it really boosted up to 70, and now people are kind of in the greed category. I just want to highlight that really great quote from Warren Buffett. When things are scary out there, it's a good time to invest. That's a paraphrase, but
It sure is.
over time, it's typically a good indication. If everyone else is selling and scared, it might be a good time to get invested there. So I just wanted to highlight that because we just feel so much energy now in the marketplace, especially with YouTubers and people on Twitter and wherever, just espousing their knowledge, which is worth what you pay for it. So keep that in mind, folks. I have a golden rule of investing here coming up at the end, Zach. Did you peek ahead? Do you know what it's going to be?
No, I did not.
Okay. I just, it's kind of a colloquialism here, but moving forward, we'll press on. I want to talk about Fed policy. It's very important. The Fed had their first rate last week. They had a decision. And Zach, I don't know if you saw this. It's the first time in 10 years that there are three dissents in the same direction. It's a very uncommon thing. And here on the chart here, I'm showing you what the Federal Reserve policy has been. About 3.75% on the um, federal funds target rate. Okay, so you can see it kind of jumps around a lot here over the last 25 years. But I wanted to highlight one other thing I saw here. Interesting. I didn't know the Wall Street Journal did this until this very morning, but they actually have information from Polymarket, which is a betting network. And essentially, the bet here, as you can see, is that what is the likelihood the Federal Reserve is going to increase rates over the next, uh, decrease rates over the next several quarters by the end of the year. And you can see here that 90% think almost 0% chance rates change or get lowered. But you can see when you went back to March, in the beginning part of the year, it was much different. Less than 25% thought so. So, this is just a interesting indication, maybe not even really worth following. Just put it in here for the sake of argument. We talked about the market doing really well. We talked about earnings doing exceptionally well. We talked about Federal Reserve policy. I want to highlight a problem, Zach. We've talked about this many times. It's kind of a reoccurring problem, but I was really shocked when you see the amount of debt the U.S. government has put into effect. This is why Federal Reserve interest rates are so important, by the way, and I'll get to that in the next slide. National debt has increased by about four trillion. God, I can't even say that over the last year. So the debt went up by 10% over the last 12 months. So I think this is a really scary indicator that things are kind of accelerating in an unsustainable way. And the point I want to make regarding the Federal Reserve policy and why it's so important, one of the reasons why is because this is the rate the government pays on interest. And so you can see here on this chart that 30-year Treasury rates, which are the long-dated Treasury rates, they have the most kind of variance or standard deviation. They're the highest they've been in almost 20 years. At almost 5.3%. You can see that. Zach, do you remember back in early days of COVID, it was 1%? It's really, this chart is really surprising to me.
Yeah, and the government completely blew the chance to lock in those rates. I think we should have issued 50-year bonds at
100-year bond they were talking about.
100-year bond, yeah, issue 100-year bonds at 1 or 2%. So they really blew that opportunity.
So
And you're completely right. I mean, it's definitely the slow burning problem. I wrote my whole last quarterly letter, which is out there if you are following any of my stuff on the national debt. Now, it is important to take it in context, right? The nominal, the headline number of 39.8 trillion. You can't evaluate in and of itself, right? I mean, that has to be compared to something, which size of GDP, right? There's other things that matter in that equation. Whether if you have a $39 trillion debt and you have a $3.9 trillion economy or a $39 trillion economy or a $390 trillion economy, right? So without the other side of that equation, you have no idea what that means. Because if we had a $390 trillion economy, then $39 trillion of debt doesn't mean anything, right? So I think it's important for folks to don't just look at that headline number, but even if you peel back the rest of it and you look at the other side, it still may not be quite as jarring as it may look. But think the headline and the net result is that it is most certainly unsustainable on its current trajectory. And
well, I guess now kind of in a war economy stance, but
yeah,
with inflation manageable, with the economy humming for the most part, we added more than 10% to the deficit
yes,
in
100%.
12 months.
Yeah,
So
should not. That's the more important point, right? Is the rate of increase in the fact that we're in, quote unquote, it's peacetime with a roaring economy. that's the problem, right? And so when you get into another crisis, and that goes from a 10% increase, well, now you have to, in order to save yourself from the crisis, like in COVID years, where deficit spending and debt, I think, made sense, right, for those first couple of years of the pandemic. Um, the different thing than to just do it in times like now. So
Yeah.
there's
That
a
goes right.
yeah,
That goes to my next slide, just kind of from the 30,000 foot view, right here from the Federal Reserve Bank. The debt, the cost to service the debt, the interest is about 18 or 19% of total federal government spending at the moment. Incredible. Just only other one government expense higher than that is Social Security, up 174% in 10 years. So I'm a libertarian by nature and fiscally conservative. Sorry to out myself here on the podcast, but this would be a concern, I think, for folks going forward. Let's get some reasonable policy in place. All right, lecture
yeah,
over. I want to talk about what are the golden rules of investing, Zach. I have about 5 arrows here pointing to the hype. Don't buy the hype. Um, I was just thinking about my career. I've been doing this for 22 years at a rather high level, and there's never been a stock that people wanted me to ask me about personally more than SpaceX. This is not a recommendation. Compliance is listening. This is only for observational value. Okay. But I had many more people ask me about SpaceX, which is not to say many, maybe 10, than any other stock in the last 15 years. Zach, what about you?
absolutely. I mean, it was
Okay.
not
So
just
that
not just clients, but advisors and people online. I mean, it was just
it was
everyone
it's an
wanted to know
exciting
about
company.
SpaceX.
Elon Musk is exciting. Oh my God, it's a very exciting company. It went IPO'd at 135, and it had a high here. I show you a chart that it was at 225 at one point. People in that first week and the month before asking me how to buy this, how to buy it, how can I do it, when should I do it? Zach, question number two. How many people, now that it's down and down, 7% today. So from the very highs of 225 all the way down to about whatever it is, 110, more or less. Down 50% since that high. How many people in the last week or two have asked you about buying SpaceX?
Nobody,
Nobody's asked
nobody.
about it.
I
So this is
know.
the point I'm trying to make. What's the discrepancy here? There's a whole bunch of hype. If there's a lot of hype, they're selling the hype. Don't buy it, please. But that being said, it's typically better to buy an asset at a lower value instead of when it's peaking after opening. So, man, if something's in the news and everyone's talking about it, it's probably a good idea not to be the one talking about it. So,
And you didn't even have to go towards like just SpaceX. I mean, you could just look at the history of IPOs. I mean, like it's not good in the first 12 to 18 months, even if those companies end up being very successful investments and very successful companies. Just the nature of, especially now, how long companies are staying private. There have not been a lot of opportunities for liquidity for early investors, for employees, for people with equity grants, right? Like, so now they have the opportunity to liquidize some of their shares and their investments. It's just the nature of IPOs, right? There's always that. I don't want to say always. There's never. There's always exceptions, but um, most often there is that initial pop, which you see it right there, right? First couple days, initial pop, and then basically a slow bleed for 6 to 12 months after
yeah,
that,
and
right? It's
just
just
because it crashed to Earth doesn't mean that it can't shoot to the moon.
for sure.
See what I did there, Zach? My
I do.
puns.
I did. That was many
Listen,
puns.
this is not a recommendation, folks, for SpaceX or any other individual company. This is just an observation. If it's just all over the news, just run the other way, my friends. And last slide before I hand it over to my friend Zach, because I know he's going to likely talk about this at some at some level. Artificial
Probably.
intelligence. I've been using it a lot. There's a lot of great things about it. It's just the access to information is incredible for work and clients. But last week in the Wall Street Journal, Mark Zuckerberg, who's the founder of Meta and they're a big AI proponent, had a very interesting op-ed. And I think he's pushing back on all the negativity. There's a lot of fear out there, and rightfully so, right? AI going to take people's jobs. I think that's why markets and people are so pessimistic at the moment. But I just want to highlight this one part where he says, if superintelligence is widely distributed, then I believe we'll see more jobs in the future, not fewer. It's significantly easier to start business without raising a large amount of capital. In other words, he's highlighting that there are, like you just said, Zach, a lot of opportunities for people with limited resources to gain access to incredible amounts of information and start things for lower cost. So this is highlighting probably the best rosy scenario, but I don't think people talk about that enough. And here's, Mark Zuckerberg. Can't you trust a guy who looks like that, Zach? I mean,
Absolutely.
that's a great photo. Anyway, so those are just some thought there. I think if you haven't used AI, it's a really important tool. And like most things, we're like Luddites, not as Luddites, but we're a little fearful of new technology when it comes around. And I think this is something that we could embrace, and we'll probably do well. So with that, Zach, I hand it over to you, my friend. What's going on?
Yeah, I mean, so I've and you'll see it probably next week or so. I mean, I've built like three separate software
I
programs
knew you were going to talk
with
about AI.
AI.
I just knew
I mean,
it.
the last, I mean, just like personally, like, and I know just enough code to be like dangerous. Like I know kind of what I'm looking at, but I can't code. I'm not a coder, right? But I've had quite a number of ideas that will help make our lives here at Independence Square a lot easier and cooler and more interesting. But I've never been able to do them. We went to a software developer a couple of years back to ask about my model management platform, and they were like, "Yeah, I mean, we could start that for like 100K in a year, and do it over a year." I'm like, "All right, I'm probably not going to invest that in something just like an idea that I have internally, right?" I built the whole thing in a weekend a couple of days ago. So
Amazing.
I mean, it is crazy. You'll see it next week. Our entire back end of our website is getting a whole facelift. It's going to be cool. It's going to be awesome. There are going to be awesome tools, proposal builders, strategy builders, all kinds of stuff. I've been having some late nights with me and Claude coding our website. So,
Hopefully your wife's not getting jealous.
well, she's asleep by then. But so to go back to what Mark said here, that AI will create more jobs rather than destroy them. I swear we did not plan this. This was just a nice segue. The data is already coming in, so you don't necessarily believe him. You just have to look into the economy as to what's happening. And so you can see this. This was a chart put out by the Financial Times. It's not some like blog, right? I mean, this is FT, like real real journalism, showing that for companies that have high AI adoption, and this is the top third of AI spending in the sample that they used, are increasing employment, not decreasing employment, drastically increasing based off of compared to the baseline companies that are not adopting AI. And so like
Incredible.
this is real economy. This is really happening. It's like, I'm seeing it just in my own usage that like every idea that you have ever had can be done right now today digitally, right? Like maybe not physical world products, but like if you have an idea for a website, a business, an app, you can build it right now today in a couple days. So like extrapolate that across the entire economy, and every company has those ideas, those interesting things that'll make their lives and jobs more efficient that they can implement, and you're going to hire more people to go after these ideas and these new business lines.
We're
So
talking about
I'm
the negativity, but this is a great indicator. I mean, if
this
things
is
go
real
this
world.
way, it could be this time is different, like we joked about earlier.
Yeah, I mean, this is, and look, there's another class of people that will say, like, yeah, that's like the initial wave, but then once you automate everything, like, then it'll crash, right? And like, it could. I'm not saying like that's not zero possibility. But what we're seeing thus far in real data, in real life, in the real economy is the complete opposite: is that AI is creating jobs, not destroying it. And then the second thing is very similar to that, going right back to what Mark was saying, that there's going to be a lot more small companies like two, three, five-person companies that have multi tens of millions of dollars of revenue, um, because they're able to leverage AI and they're able to just do so much more with less and just have that idea and bring it out into the marketplace. And so new business applications are surging. And you kind of saw that initial jump during COVID because everyone's like locked in their house, kind of plateaued through the next 3-4 years. But then you're just seeing another inflection point higher in the last 12 to 18 months of just small new businesses starting, new ideas coming to the marketplace. Now, this is like, top level business applications, right? This doesn't mean they all have revenue. That doesn't mean they all have a successful product, right? Like, so like there's some noise built into this. Like this is just that top level indicator, but it's interesting to see that people are taking that step and hey, starting a business with that idea that they had. Crucially, at a time when the unemployment is where it is, right? So it's not a situation where like, hey man, I got to start a business because I can't get a job. It's like no, like employment's 4%. It's like so that's not the case, right? Which I just thought was really, these two kind of indicators together are really
Exceptional evidence.
exceptional, and showing you that optimistic case for the employment
Which
aspects
would you say
of
in
AI.
some way is kind of being built into the stock market at the moment? This is
A
some of the
hundred
exuberance that
percent,
we're seeing. And it seems to be that it could be supported with those two data points, Zach.
a
More
hundred percent.
hiring, more job applications. That's exciting stuff.
I mean, you just saw it the last like 3 or 4 days, like at the slightest whiff of there being a resolution to this Iran controversy, you're just seeing the market like, okay, thank God, like, can we finish that so we can get back to like the main thing right now? Like, can we get back to it? And you see the market like surge 700, 800 points, because look, there is real risk of oil supply chain disruption and eventual demand destruction. Like if that's not sorted out, like that does have knock-on effects eventually, right? But I think the market just wants to be like, can we just finish that? Can we finish up, please, and get back to what else is happening? Um, and so, we talk all the time about the comparisons to, the dot-com era, the fiber build, the build out. And I love these kinds of data points on the next slide, just showing like in the early 2000s when all that fiber optic cable was getting laid, it was in like the, hey, if you build it, they will come kind of situation, right? Like they were like, we're going to lay all this fiber and everyone's going to use it and it's going to be amazing. It's going to be fantastic. And it just kind of didn't really happen. Like, it eventually happened. It all was used eventually, but it was like 10 years too early, right? It just that there wasn't enough demand at the time they were putting it in the ground and laying it, and that led to significant overbuilding at that time. Not the case with GPUs in AI data centers. I mean, these are at,
GPUs for the uninitiated.
yes, that is a graphics processing unit, which is the
And so this chart
chips
is
that,
showing what percentage of that technology is being fully utilized. So for your point, fiber optics, only 7% of that laid was actually being used at full capacity, correct? And then this
yeah,
80% is
and that was, I think in 2001. So that was published in 2001. And then eventually that usage did go up quite a lot, but it was just like, it was way behind. They were building a lot more than the current demand indicated. And GPUs and AI data centers are all being used. I mean, 4/5 of them, 80% plus, are being used, and there's just an overwhelming demand for compute, and that's what you're seeing. And so it's, the demand is coincident with the build out, with the investment, um, and so it's, a very different situation. You had talked about the valuation kind of decreases with, U.S. tech, but if you also compare the valuations of the S&P 500, U.S. large cap equities with global equities, that ratio has also had a reset, in the last 6 months or so, really actually the last year and a half, because international equities have done really well. U.S. equities have done fine, but not comparatively as well. And so now we're, essentially back to the, multi-year average, below, back to kind of pre-COVID ratios.
and what do you
Um,
think this means?
well, I think the rest of the world, had some catching up to do. I think that was kind of a mean reversion because the U.S. had outperformed for 6 straight years, basically, right? And so I think there was just some aspect of mean reversion. There was capital that looked for, a home. The interest rate differentials, as our interest rates rose, that changed some of the dynamics of international investing. So there was a number of reasons why, but if you kind of look at the you know differential between U.S. stocks and international stocks, we're back to kind of equilibrium again. I think, if you kind of go back to kind of pre-COVID time. So we've had a lot of like resets in a lot of these valuation metrics, and I don't think anything is. You wouldn't look at the market and say it's cheap, but I also don't think the narrative of it being expensive is valid either.
Agreed.
Moving on to a crazy chart. This is the generational transfer in free cash flow between the hyperscaler companies, which are doing the investing, right, in the AI build out. So that's, Amazon, Microsoft, Meta, and the semiconductor companies that are being the recipients of that build out. and you're just seeing like the cash going in a avalanche in one direction. Um, you know, you kind of look at that as not necessarily bad for the hyperscalers, right? Because they're investing for the future, but it definitely is good for the semiconductor companies who are just they can't, again, can't keep up with the demand, and so they're able to command higher prices. They have multi-year backlogs, and so they're able to generate massive amounts of free cash flow. And it's just a really stark chart. It's just a crazy when you see something that drastic. Just pretty interesting to see.
Very interesting.
And then the last one here on the AI build out, and this is just going to the household level. And so this is like share of US households with paid AI subscriptions, and then the ones that are paying, how much are they spending? And you can see the pretty stepwise increase in the bars. Then you look at the y-axis and you look like, okay, well, what percent are the share of US households paying? And it's 2%.
Nobody.
Nobody, basically. Well, I am, but not many people. And so you can look at that two ways. You can look at that as saying like, hey, it doesn't have market penetration yet. Is it ever going to get to significant market penetration? And people will people actually pay? Will 20% of the country pay for AI services and AI tools? But the flip side is that you can look at it and say like, this is so early, so early, like beginning of the first inning, like batting, like warm-ups. Like we're not even at the game hasn't even started yet. If you kind of look at where that could go for potential saturation, and like you look at some other major technologies, like internet saturation is like 98%. Cell phone saturation is like 98% in developed economies. And it's like, okay, we don't, even if it doesn't get to 98, like can it get to 28? And what does that mean for revenues for these AI hyperscalers and for these companies that are
Now,
building this stuff
considering
out?
Zach, when you say you use AI, are these called chat agents? Would you consider them chat agents or chatbots as well?
For who's paying for these, you mean?
Well, no, because I'm just looking at some Pew Research here, and I was curious of what percentage of Americans use AI at all, right? So we say 2.2% of people pay for it. What percentage are actually using? Because the freemium models are pretty freaking good, and I think a
Yeah,
lot of people are out there using this. So according to this Pew data, it shows that there's a like 50% of people are using chatbots, but I
yeah,
think they mean like ChatGPT. I mean,
yes.
I just don't think about it with that verb, you know?
Yeah, no, yeah, that's what they're talking about is chatbots. I mean, OpenAI just crossed a 1 billion monthly active users, the fastest company to ever do that. I think TikTok was like 3 times as long, and that was the second most. Um,
Hmm.
and to reach 1 billion monthly active users, right? So people are definitely using it. It's just how many will pay for it. And so like that's the open-end question. Like we don't know. A lot of folks are saying that the AI, LLMs, large language models will end up being like a commodity, and the value layer is what's built on top of it, right? It's like the
Mm.
apps and the programs that are built on top of it. That could be true, and maybe it's going to be more of a commodity. And you see that kind of with some of the open source free models coming from China. They're gaining a lot of market share even with domestic companies because it's just so much cheaper to run. I mean, that's one issue that I notice when I'm building stuff is like I hit my rate limits, and it's like, okay, you got to wait a couple hours, and come back to it later. And so companies are looking for ways to reduce that spend. Like they want to keep building the tools, and you do that balancing question of like, okay, well, what's worth more? Is it the spend, or is it like if you're doing something that doesn't have like particular data security implications, like, yeah, okay, you can use the kind of free Chinese model. It's 80% as good for 20% of the price. So it's like that's definitely a conversation a lot of companies are having and trying to figure out like where that's gonna land. But um, I think regardless of where it lands, I think it's going to be a lot higher than 2.2%. People are going to pay for it, right? So I think you have a lot of runway, and you're seeing it continue to grow on a pretty stark curve.
Speaking about going on a stark curve, that next chart is pretty interesting.
Yeah, I was really surprised to see this. I think this is interesting. I don't think most people would guess this.
I don't think
That
anyone would guess this based on the crying out there in the blogosphere.
right, and this is from Pew Research, the U.S. Department of Commerce. Like this is real data. So this is showing you that at certain ages versus millennials, Gen X, and Boomers, what is the real net worth per capita? So it's not it's inflation adjusted, right? So it's not based off of inflation numbers or anything like that. And it shows that millennials are above both of those generations that in their mid 30s, right? And
It's
um,
crazy. I would never believe it.
I think that's a really I was surprised to see it. I would not have guessed that to be the case, but I mean, the data is the data. And, I think that maybe they're better off than we thought. And I think a lot of it has to do with, I mean, there's so many reasons why it doesn't feel that way. Because I think some of the things that you spend money on, are different than prior generations. I mean, if you look at just as an example, like home size by square footage. So
Mm.
like the average home by square footage in the 1980s was like, I don't know, 1,800 square feet or something like that. Um, and now it's like close to 3,000 square feet. It's like, well, yeah, I mean, it's okay. It costs, like, that's what people want nowadays, right? So you're not comparing apples to apples necessarily. It's like, oh, I can't afford a house. I can't afford a thing. It's like, well, maybe you can't afford the 3,000 square foot house. It's like, but you could buy the same house that your parents, lived in, or your grandparents. Like it was a different type of
I wonder
um,
if a lot of it has to
type of
do also
need.
with, a lot of this generation don't have homes, but they probably have much bigger 401ks than their parents had, if
Well,
I'm
that's
guessing.
and so that's a lot of them didn't have 401ks, right? I mean, if your grandparents, right, 401ks didn't exist that far back.
But their parent, I'm
Um,
talking about their parents'
Their
generation.
parents, yeah. But I think this next chart shows maybe why there's that undercurrent of like feeling that they're not doing as well. And I think it's because the gains are not as well distributed. And right, it's kind of that goes to that kind of K-shaped concept that while on an aggregate, maybe the generations are doing a little bit better than you felt that you were, but I think if you don't own capital, if your primary source of wealth is labor only, then you aren't doing as well, right? And I think that a lot of the gains are going to folks who own capital. And that's folks who have investments, right? Who own 401ks, who have stocks, who have real estate, who own homes. They're seeing their gains come at the expense of folks who are just providing labor. And so you kind of see that bottom third of the economy really not doing well, right? And they're continuing to struggle to keep up uh, against those prior generations, while the top third is doing very very well. And then if you take that on a per capita basis, it looks like that first chart, right? You know what I mean? Um, and so I kind of feel like that's a bit of an explanation for why there's that undercurrent of a sense of not being able to keep up, while the numbers would tell you based off of net worth per capita they are, right?
Yeah, I think so. A tale as old as time, discrepancy in wealth outcomes. But
Yeah, and I think
great.
this is going to continue to drive, election results, and we're seeing it more and more with how folks are voting and how disaffected people are with, traditional parties and the traditional policies. And I think you're going to kind of continue to see that as long as these trends, stay how they are. So it'll be an interesting election cycle. I think we'll really get a kind of a sense. I think there's more um, like true progressive candidates like running for big offices this year than we've had maybe ever outside of some of the traditional strongholds. And so we're going to get kind of a sense of like, what some of the rest of the country's feeling about some of this stuff,
Certainly a
in a
topic
couple
for
months.
next quarter's
Next
Finance
quarter.
Footnotes podcast. Just around the corner, folks. We
Yeah.
touched on a lot of great material here. Zach, thanks for the great ideas, and hopefully you found that useful, friends. If you have any questions, let us know. Otherwise, we'll see you in a couple months on Finance Footnotes.
and maybe you don't need as many seats. Maybe, maybe there are some companies that will do it themselves. Sure, right? It's a competitive landscape. But I think that Salesforce itself, and I'm just using Salesforce as an example, but there's 100 other, of these software companies. Um, they're going to be so much more efficient, right? They're going to be able to do so many more things with what they have and be more productive. And so I'm not as negative on it because I really think that data security risk is going to be a huge piece of the puzzle moving forward because of how easy it's going to be for bad actors to use AI nefariously, right? To attack these systems. And so I don't think anyone is going to be taking that risk on themselves internally. They're going to use a well-trusted, well-funded company that's their job to protect their data. And so I haven't been as negative on that. And you kind of see the market. I think initially it was like just sell everything software. Now it's rebounded, and I think the market's kind of repricing that concept. So all of that feeds into the fact that the private credit thing I think is potentially a little overblown.
Agreed.
And the last thing we want to look at is just a somewhat um, positive development that I wouldn't have guessed was the case. Um, and this is the percent change in net worth versus the income cohort. So you got top 10%, next 40%, bottom 50% in the 2020s. So since 2020 to 2026, or more than halfway through the decade, what is the percent change in net worth? Now, all income cohorts have seen their net worth grow this decade, but the bottom 50% has actually grown more than double the rest of the top 50%, which is something I wouldn't have guessed. This is from Ben Carlson, a Wealth of Common Sense blog. He always sources really, really good stuff. Now, it's coming from a smaller base, right? Obviously, in absolute terms, it's not equal. But in relative terms, it's certainly a positive development that kind of goes against that K-shaped narrative. You hear that a lot. That we're in a K-shaped economy, and the bottom, is doing worse and worse and worse, and the top's doing better and better and better. Well, this kind of is a data point refuting that. That actually the bottom has kind of come up a little bit. So it's a
More
positive
than a little
development,
bit.
and I think something that's really important
This is in six
politically
years.
and economically.
Yeah, just over the last 6 years. So this is
Yeah,
exceptional increase in just the last.
yeah,
Obviously, you have a big dislocation there with COVID, but great way to end, Zach, on a positive note. I think we touched on a lot of great things here in the podcast, folks. If you have any questions, as always, please let us know via email or reach out to our assistants. We're always happy to answer those questions. And we look forward to seeing you next time on Finance Footnotes.